For what feels like forever, right? The story of the global economy has been, well, pretty simple. America innovates, Europe stagnates. But what if that's just not the right story anymore? Especially for the world we're heading into. Today, we're going to dig into a totally different narrative, one that asks a pretty big question. Who is really built for a crisis?
I mean, this is the common wisdom, right? You hear it everywhere. The US is this dynamic engine of innovation, with all the fast-moving tech giants. And Europe? Well, Europe is a beautiful museum, kind of weighed down by all its rules, super slow to change. And let's be honest, it's a story that just feels true, doesn't it?
Okay, but what if all those things we call weaknesses are actually hidden strengths? What if Europe's boring, stable way of doing things is exactly what you need when things go sideways? See, that's the big question we're really getting into today.
All right, so to really get Europe's hidden strengths, we've got to be honest about the stuff everyone already knows, its familiar weaknesses. I mean, there's no point in just pretending they're not there.
Yeah, the standard diagnosis is pretty straightforward. You've got the big players, Germany, France, Italy, and they've been kind of stuck in this low growth rut for a while now. Then there's the whole single market dream, which is still bogged down by so much national red tape, making it super hard for companies to get big. And maybe most importantly, there's this ongoing problem of just not investing enough in the future. In this chart right here, it just lays it all out. Just look at the spending on R&D. The EU is a full percentage point of GDP behind the US. That is a massive difference. And honestly, it explains a whole lot about why you don't see a bunch of European tech giants.
So you put all that together, and the conclusion seems pretty obvious, right? It feels like Europe is playing for yesterday's prize, just kind of falling behind in a world that's all about speed and disruption. Case closed, or is it?
All right, now this is where the story takes a turn. Because what if all that boring, conservative, rules-based stuff is actually a superpower, especially in a world that feels more fragile and unpredictable than ever?
You know, at its core, it's really a difference in philosophy. The US system, it's all about winning the booms. It's built to maximize growth when everything's going great. But the European system, with all its regulations and safety nets, well, that's built to survive the busts.
And you can totally see this philosophy reflected in their stock markets. They aren't packed with high-flying speculative tech stocks. Nope. They're heavy on real, tangible stuff. Industrials, utilities, healthcare, consumer staples. Look, it's not sexy, but it is defensive. Think about it. People still need electricity and toothpaste, even in a recession. Plus, these sectors provide steady jobs, which helps hold the whole social fabric together.
So when a crash eventually comes, and let's say, for example, the AI bubble pops, Europe is just less exposed. There's less debt, less of that speculative froth, fewer insane valuations baked into the system. Turns out, in a crisis, boring is beautiful. But Europe also has this other, much quieter kind of power. Through things like GDPR for data privacy or the new AI Act, the EU is basically writing the rulebook for the entire world. Why? Because global companies look at it and realize it's just easier to adopt the strict EU standard everywhere than to have different rules for different places. That's real influence, not through tech dominance, but through regulation. And man, is that a different model from what we see across the Atlantic. Okay, so now let's flip over and talk about the United States. That incredible dynamism, for sure, it's its greatest strength. But it might also be hiding a pretty big vulnerability. So here's the argument. The biggest thing holding the American economy back isn't a lack of good ideas. It's that the whole political system is kind of captured. It's captured by the interests of people who own assets, stocks, bonds, houses. It seems like almost every big policy decision gets boiled down to one single question. Will this make asset prices go up or down? And this creates this predictable and, frankly, dangerous reflex. It's like a playbook. Step 1, a crisis hits. Step 2, protect the asset holders at all costs. Step 3, the easiest, politically safest way to do that is to just have the Fed print a ton of money to keep the markets from falling. It's basically become the only tool they reach for. And you really don't have to look far to see this in action. Take this recent quote from Donald Trump. It's a perfect example. I mean, on the surface, we will protect homeowners. Sounds great, right? It's populist, it's reassuring. But what does that actually mean when it comes to policy? Well, in American politics, protecting homeowners is basically code. It means protecting the value of their house, which is their single biggest asset. It means stopping the market from doing what markets do, which is have corrections. And it means the government steps in to cover the losses, socialize them, while the gains stay private. This isn't really housing policy. It's asset price policy, plain and simple.
Okay, and this brings us to the really crucial part of the whole argument. America's one-trick pony policy, it only works because of one thing: global trust. And that's something it might be, well, slowly losing.
See, this ability to print money without facing immediate disaster, some people call it America's free rent. And it only works for one reason. The US dollar is the world's reserve currency. Other countries are willing to take all those freshly printed dollars and use them to buy US government debt. It's that global demand for dollars that keeps the whole system afloat. But here's the thing. That's not a guarantee. It's not going to last forever. And if you look around, you can already see the signs that the rest of the world is hedging its bets. Central banks, they're slowly but surely moving some of their reserves out of the dollar and into other currencies. They're buying up physical gold like crazy. And you're seeing more and more trade deals being settled in local currencies, completely bypassing the dollar.
Now, let's be super clear. This does not mean the dollar is going to collapse tomorrow. But what it does mean is that every single time the US fires up that money printer, the price gets a little steeper. It makes inflation a bigger risk, and it makes foreign investors just a little more nervous. That universal solvent is bit by bit losing its magic. So, after all that, where does this leave us? Let's pull these two very different models together for one last look.
And honestly, this table just nails it. You got the EU, which is all about rules and stability. Its superpower, surviving the busts. But its big risk is getting stuck in a rut, long-term stagnation. Then there's the US, biased towards asset prices and growth. Its strength is absolutely crushing it during the booms. But the risk? A fragile financial system that's vulnerable because of political capture. And this, right here, is probably the most important takeaway from this whole thing. It's not about which system is better in some absolute sense. The real question is, which system is better built for the kind of world we're actually heading into?
The last decade was all about speed, growth at any cost. But what if the next decade is about something different? What if it's about stability, about resilience, about weathering the storms? If that's the case, then you really have to ask yourself, who is truly prepared?